Do you think that inflation is going to come down quite convincingly? Because we're expecting core inflation to look once again a little bit sticky in the US this week.
Yeah, I think bond yields will come down gradually, probably mainly in the second half of the year, Anna, and the bond market tends to lead the policy rate. So the policy rate very much lagging what the market expects, and it's the same with inflation. I think you could probably say that the inflation data and the unemployment data are really very much backward-looking now, and we've kind of moved on. It seems to me that there is some stickiness in some aspects of inflation, and it may take longer than some people have wanted. But the reality is that the more forward-looking indicators, and of course, you know, it's the reality that the Fed has to balance the outlook for growth and inflation and consider financial stability. So all of that says to me that we're probably at the peak. Most fixed income investors know that you're supposed to receive, or in plain English, buy around the penultimate rate hike, and we might well have had that.
Okay, so it's now time to buy, if we're bound the penultimate rate hike, and now time to buy fixed income. And I know you prefer the long end. Is this 10-year or 30-year? And like, what kind of yields are you targeting by the end of year?
Well, yeah, so the penultimate rate hike, as you know, Mark, the one before the last, and so we don't know whether we've had the last hike yet. It seems quite possible. The 10-year we prefer on the curve, and we're looking for a steeper 10 to 30-year segment. Our forecast for the 10-year is 2.5, and that hasn't changed since last year. In terms of the absolute timing of buying bonds, obviously the peak was last October. We had another go at it a few weeks ago, but the peak was 4.24 for the 10s back in October. So the peak is well in the rear-view mirror. I mean, that was 80 basis points ago. Of course, I would like to buy bonds more cheaply. One of the problems for investors is that at the front end of the curve, the 2-year note is 100 through money. So that becomes very difficult to buy at this level, even if eventually yields do go lower.
So, Stephen, just to follow on that, like, you think that 10-year yield is going to get back to 2.5% towards around the end of the year. How high do you think we might get from here on the path? You're saying the peak is in, so you're saying we're not going to get up to 4.3% again. But what do you think might be the peak in yields between now and year end? And similarly, I think when you then talk about the 10s, 30s curve steepening, where are we talking about getting to? From the steepness of a few years ago, or even more steep than that?
Yeah, I think it's difficult to get to record steepness right now, because you actually need the policy rate cuts to be coming through, and you know, that could take some time. I think the 10-year yield is about 80 below the peak already. So on the point that everyone wants to buy at cheaper levels, I'll say that I want to buy before everybody else does. And it's quite interesting how most people would have had a four handle on their bond yield forecast. So as that becomes redundant and people have to reset their expectations to a 3 handle, then maybe that's the time when we start to look at yields going even lower. But you know, timing is everything, and I think that most of us who look at the bond market closely would recognise we've had a very strong performance already in the last 2 quarters. I mean, believe it or not, you've been in a bond bull market for 2 quarters. It may not have felt like it, but yields are significantly lower than the peak.
Okay, yeah, thanks for identifying it for us. Stephen, what about, so Mark talking there about the curve, what about specifically at the front end, and what messages you're taking away from the front end? Because clearly it's all been messed up by the tensions in the banking sector in the United States. And I wonder how clear the messaging is around recession or not recession from that front end.
Yeah, so central bankers don't want us to be getting ahead of ourselves. They're still focused on the data. You're hearing some officials saying it doesn't matter what the market says. They think rates are going up, and that's all that matters. All I know is that when the 2-year note is this far through the money rate, and it's been 100 basis points through recently, when it goes this far through, the Fed's always in an easing cycle. There could always be a first time for everything, Anna, so we could be wrong. But again, most people that look at this will recognize that when the 2s is so far below money, they're normally in an easing cycle. So it's about getting the timing right. I was thinking it would be great if the 2-year yield could get up to 4.5. It would be a great level to buy, but that seems a long way away from here now. So I think that people will be looking to enter the bond market on any upward correction in yield now.